Good morning and welcome to this next episode of Governance Dialogues. My name is Elisa Cole and I'm the Managing Director of Governance Center. And as for previous episodes, I will be your host today to discuss a topic and in fact, we'll be opening our fall season of Governance Dialogues with this topic, and that is the tensions between the American and the Chinese administrations, and notably the effect that they're having in the capital market space and in the governance space with recent developments we've been seeing all over the news, affecting Chinese companies, notably dual listed Chinese companies listed in the United States, with various orders that President Trump had signed and various developments we've seen over the last few weeks affecting Chinese large dual listings in the United States. So we'd like to focus or dedicate this episode to exploring these rather complicated issues as they're unfolding, which arguably have started or perhaps started earlier, but in a kind of a more visible way, have started with the aborted IPO of Ant, which would have been 4 billion stock market debut and would have been, in fact, larger than the Saudi Aramco listing. We've also seen in recent months announcements by the Chinese government affecting tech companies, specifically, notably Tencent and Baidu, and some negative effect of announcements regarding data privacy issues affecting Didi's IPO in New York, which was a ride-hailing platform whose shares have tumbled quite significantly. And more generally, we've seen around a 45% decline in the New York Golden Dragon China Index since February. And as The Economist mentioned, I believe in last week's edition of the magazine, we have at stake about $1.5 trillion of listed companies and equities, some of which are cross-listed in Hong Kong as well, but most are just listed in New York. So quite a number of interesting issues that are coming up, both from a governance perspective, but also from a broader political perspective, and how the tensions between the two countries are playing out in the capital market space. And I believe it's a really interesting topic to consider now, which affects investors and large institutional investors quite significantly. And I couldn't think of a better person to invite to have this conversation with than Jamie Allen, who is the Secretary General of the Asian Corporate Governance Association, and who's joining us today from directly from Hong Kong. Jamie, welcome to Governance Dialogues. It's such a pleasure to have you.
Thanks, Alyssa. Pleased to be here.
So thank you for joining us. And I know you have a unique perspective on these issues, having worked in the region for such a long time. Perhaps let me say a few words to introduce you. Of course, I've been following your work closely over the last, I think, decade or so, heading up the work of the association. But you cover currently 12 Asia Pacific markets at the Asian Corporate Governance Association, which is, for those of you who don't know, an independent non-for-profit organization dedicated to working with investors, companies, and regulators on promoting better corporate governance standards. And it's been in existence, if I'm not mistaken, for about 20 years now, and it's been doing some really interesting work in terms of thought leadership, but also engagement with regulators and investors. And you've had kind of very in-depth or experience not only leading that organization, but also at the Economist Intelligence Unit and working with the Hong Kong Stock Exchange and in various roles that I think really give you a unique perspective on the Asian markets. And of course, your work has been awarded by a number of organizations, such as the ICGN, which gave you a Lifetime Achievement Award. So really a pleasure to have you. I think my first question, just to dive directly to the topic or to the heart of our conversation today, is really around developments following Ant and Didi, as I mentioned, and perhaps more recently the announcements related to the various variable interest entity, as they call them in China, and the effect on the education sector, which has left investors even more nervous. How do you feel that these announcements have affected markets in recent months, investors on both sides, the Chinese and the Americans, and perhaps more broadly global investor community?
I think they've had clearly a very significant impact on investor sentiment towards China tech firms. Clearly prices of the tech firms have come down as the Chinese government has sought to, exert greater control over them, both in terms of cybersecurity, in terms of data privacy, anti-monopolistic practices, and so on. So I think, to a large extent, I think the market wasn't expecting this. However, if you read the tea leaves in terms of what the Chinese government has been saying in recent months and over the past couple of years, including speeches from Xi Jinping, particularly, for example, regarding the education sector, which is the latest sector to be clamped down upon, I think the signs were there that something was going to happen, perhaps less so with the internet firms. But certainly, there are some signs that the government was becoming concerned about the business practices of some of these firms and the impact it was having on Chinese society. So, but having said, that's not justifying the way the crackdown was done. I mean, I think you need to look at the content of what the Chinese government is doing and also the way they've done it. And even if you might agree with some of the content in terms of, for example, cracking down on some of the monopolistic practices of the internet firms. Still, the way it was done, I think, raises some disturbing questions, the lack of communication, lack of transparency, lack of public consultation. So this is a sort of an ongoing theme in China from a financial regulatory policy point of view that, there really does need to be more transparency and more signaling to the market as to what's going to happen, rather than the market being taken by surprise. So that's been a particular area of concern, I think, for international investors.
Absolutely. And I think what's interesting, and I've been covering that in a couple of articles that we've published. One was called the capital market tug of war between US and China. And there's another one that's been published specifically on the dual listings. And I think that's perhaps an interesting, particularly interesting space to investigate. And I've had a conversation on this program many months ago with Carson Block at the time when the Luckin Coffee case was unfolding. But we've heard, of course, of the two presidential orders by the Trump administration, classifying some of the companies or resulting in delisting of the three tech firms, telecom firms immediately from the US exchanges, and then subsequently the passage of an act that essentially would require Chinese companies to hand over or to allow the American audit regulator, the PCAOB, to inspect company papers. And this is something that's been a source of tensions, not only between the Trump administration and the Chinese administration, but also previously, even under Obama and whatnot. So this is something that's a discussion that's been going on for some time. And the bottom line is that as you know, if in 3 years they don't allow for access by the PCAOB to their audit papers, essentially these companies can be delisted. What do you make of that development? Is that something that you believe will be resolved in due time, or are we seeing really kind of a watershed moment in the capital market, let's say, relationship between US and China?
I think it is actually something of a turning point or a watershed, actually. I think what's quite interesting, we've been looking into this Holding Foreign Companies Accountable Act recently. And clearly there seems to be an expectation among many in Washington that China is going to compromise and that China will allow a sharing of audit working papers for these PRC listed firms in the US. And therefore then the US won't have to pull the trigger on delisting. But right now, we can't see any evidence that Beijing is going to compromise. We can't see any upside for Beijing compromising. And they've made it very clear in the past, and this has been going on for now 10 years or more, that they're not going to share audit working papers. So we can't see, and given the geopolitical tension between the two countries, we can't see any particular reason why this is going to change in the next 2 or 3 years. But interestingly, on the US side, the law is supposed to, the law took effect this year. So some people are thinking that perhaps the delistings will start in 2024. However, the SEC and the PCAOB still need to go through a certain amount of rulemaking. So it looks like it won't start until next year. The starting point won't be until 2022, which would be pushing it back to 2025. Our bet is that perhaps some of the US there will be pressure in the US from, the usual interests to push the start date back as long as possible, hoping that China will compromise. But it is a little hard to see, what's going to change in the next couple of years that would lead to a compromise on the Chinese side. But I think it's also worth remembering that, to some extent, this is a problem of, the US's own making, that if going back when the PCAOB started, if the US had said no mainland company can list in the US unless we have a right to supervise the auditors of those firms, and the auditors would be in China, then if they'd made that very clear from the beginning, and if China had agreed to that, then presumably we wouldn't be in this situation today. So I think to some extent, it's a little bit like the tech firm issue in China. China allowed these firms to become massive. They kept out foreign competition. So that allowed Tencent, Alibaba, Baidu, all of them to become very large. So it's not surprising that, then they became somewhat monopolistic. So I think that to some extent is a problem of China's own making. I think, the issue of these, the possible delistings of PRC firms is to some extent a problem of the US's own making, I think.
It's interesting, that you're making that point of problems of their own making, as you say, because indeed that many of these sort of developments have snowballed over time, over many years, and the discussion on auditors has been going on for quite some time, with frankly not completely unreasonable arguments on both sides. I think a really complicated issue to sort out, and I think what's interesting, and this is the last piece that I wrote about, talks about that, is it's kind of perhaps in modern history, the first time that, political tensions are playing out most visibly in the capital market space, and perhaps not in other, kind of spaces that they could play out on, for example, between regulators of tech companies in the US and China, but really much more squarely in the capital markets or securities regulation space. And that sort of begs me to wonder about prospects of what will happen to these companies. And of course, there's been, as you know, quite a bit of speculation. Some of these companies have depository receipts listed in Hong Kong, and so there's been discussion about whether there will be a shift of listings of Chinese companies who still will need to access deep liquid pools of capital to Hong Kong, or perhaps, would they become, as mentioned, a friend who's a regulator in another emerging market, they will become regulatory refugees, for the lack of a better word, and washing up or coming to markets or tapping into markets in other emerging market or developed market jurisdictions where they haven't traditionally been going to. And, for example, there's as you also know, a huge competition between London and New York, whereby, Chinese companies could also, let's say, decide to go to London. How do you see these sort of listings moving? Are they just going to basically stop? Or are they going to come back to China? Or are they going to look for perhaps other avenues where regulatory barriers are not as high?
My bet is that they will continue to want to go to the US primarily. Some may go to London, but then they'll face the problem, of getting permission to go to London. I think, the capital markets in the US are more liquid. Many PRC companies have gone there. If they're able to go there, they will. But then they come across the hard stop, presumably the hard stop of the, Holding Foreign Companies Accountable Act. So, how the US deals with that is, I think, going to be interesting. From the Chinese side, I don't think what's happening with regard to, say, Didi means that no PRC private firm will ever be allowed to list overseas again. It does seem that, the Cyberspace Administration of China is going through a process of coming up with new regulations. Presumably, some company will, meet the new regulations and be allowed to list overseas, subject to heightened standards from within China. But then again, what happens in 3 years or 4 years' time, if those firms are then going to be delisted from the US. So, it's quite a few imponderables. But I think what definitely is happening is that the PRC listed tech firms are coming back to Hong Kong. We've seen Baidu, we've seen Tencent, we've seen Alibaba, we've seen JD.com. NetEase, and quite a few of them are coming back as secondary listings in Hong Kong. And this raises a particular issue because as foreign private issuers in the US, they're given certain corporate governance exemptions, such as around disclosure of remuneration of directors, senior managers, the holding of AGMs and so on. Baidu hasn't had an AGM, as a US listed company for years. Hong Kong has slightly higher standards on the holding of AGMs, but if you look at the waivers that the secondary listings get, Alibaba got a whole raft of waivers, as did the other tech firms that came back. So if they come back to Hong Kong as a secondary listing, they get a lot of waivers, and some of those waivers they get because they don't have to comply with rules in the US. So in a sense, they're given waivers in the US, and they can sort of bring those standards and waivers back to Hong Kong. So our concern is not so much for the governance of these companies, because I don't think it dramatically changes the governance of these companies. It's more the impact on Hong Kong that you now have some very large companies with lower standards of disclosure and governance being allowed to list in the Hong Kong market. And some of these companies are getting onto the local indexes, the Hang Seng Index, for example, which is our main index here.
Yes.
So I think that really clearly does raise governance risk for investors.
And so, Jamie, just to follow up on your point on Hong Kong, which is an interesting one, I published a piece, which I mentioned earlier, that talked about also stock exchanges. And actually, I had somebody from the Hong Kong Stock Exchange write to me to raise some points, perhaps, of disagreement on a couple of things. And obviously, the announcement by the Hong Kong Stock Exchange related to the disclosure of identity of board members, or the changes in this disclosure, has actually led to quite a bit of investor outcry. And I believe the association that you lead has also commented against these kind of rules that would water down the quality of disclosure. Do you think that going forward, in the context of this possible shift of listings, and also the current sort of geopolitical context between the US, China, and Hong Kong, do you think that perhaps the rules of the Hong Kong Stock Exchange also are under pressure to, let's say, facilitate listings with, let's say, lower corporate governance or transparency requirements going forward?
It's a question we sometimes get as to whether Hong Kong is lowering its standards to please China. And that was a question we got when Hong Kong brought in dual class shares for the first time back in 2018. Our answer to that was no, and I would say my answer to you is no. I think Hong Kong is very much a homegrown issue. The changes to the Hong Kong listing rules are very much to try to enhance, quote unquote, the competitiveness of the Hong Kong market, make it easier for companies to list. Hong Kong has wanted to get these tech firms from China to list here, hence allowing dual class shares, hence making it easy for secondary listings, hence allowing more sort of diluted rules for overseas issuers. So that's all part and parcel of Hong Kong's sort of strategy to sort of remain competitive, particularly vis-a-vis the US. And I think another piece of evidence that it's homegrown, not directed by Beijing in this instance. I mean, many other things in Hong Kong are driven by Beijing, don't get me wrong. But when it comes to the stock exchange listing rules, Hong Kong brought out 3 years ago changes to allowing dual class shares, allowing easier secondary listings, and allowing pre-revenue and pre-profit biotech firms. Very quickly, Shanghai followed suit with their new science and tech innovation board. So there's a lot of competition between Hong Kong and Shanghai, Hong Kong and Shenzhen. So I don't think Beijing was particularly telling Hong Kong, to lower its standards. I mean, Hong Kong's entirely capable of, shooting itself in the foot, believe me.
Okay. Now it's interesting you comment on that, and indeed I've also been covering, and we've been writing a lot about even when I was still at the OECD, writing quite a bit about stock exchanges and their listing rules and where do they come from and what are the pressures. And indeed we've seen in the listing or the fight for the 5% of Saudi Aramco's listing, how LSE was willing to to lower its premium or consider lowering its premium listing standards with regard to related party transactions. And there are many other exchanges that are kind of potentially engaged in this what some call race to the bottom. So it's an interesting space to watch, I think, in of itself. And as you point out, some of it maybe is not related to geopolitics, but related to, let's say, politics between exchanges themselves. But that leads me to also ask about questions related to listings more generally. I mean, we talked about, where they would go, whether it's US, Hong Kong and whatnot, but listings from China, I mean, that is in itself a phenomenon of itself, in the sense that we know that market issuance, especially primary issuance, has been down enormously in European markets, in the US, and that in the US and in Europe, it decreased for about 78 billion during 2000 to 2008, to 51 billion over 2009 and 2018, according to OECD data. And yet what we're seeing, and it was in depth described in the OECD Asian Capital Markets report, is that Asian companies have in the same period have increased their issuance quite a bit to about 67 billion in that same period. And of course, much of that was driven by issuance of Chinese companies. So I wonder if you have thoughts as to kind of what might be the speed, or is that same appetite for going public going to be, or driving the development of Chinese markets? Are Chinese issuers, in other words, as hungry as they are for equity now as they were in the past, let's say, decade?
It certainly appears that there's a lot of hunger for equity, whether it's a listing in US or Hong Kong or China itself. And I think it's worth remembering that the banking system in China traditionally was a state-owned, well, still is a state-owned banking system, and primarily serves the needs of state enterprises. So it's not that private companies don't get any bank loans, but quite often they have to rely on their own resources, friends and family. They don't have as much access to financing as state enterprises do. So hence the move overseas to the US and Hong Kong. And I think one thing that's worth highlighting here is that just how bizarre this whole situation is, because what you have here is a country whose own capital market is not serving the needs of all of its enterprises, state and private. So some of the best firms from China in the last 20 years have had to go overseas to be listed, which means that until we had the Stock Connect scheme in Hong Kong, many of these firms were off limits to mainland Chinese investors. So you have many of the best firms from a country listing abroad, and basically the profits and the returns and the value of those listings primarily going to offshore investors. I mean, I'm not aware of any other country in world history that's had that approach to building, up its stock market. So, I think many of these companies should be listed back in China. At least a listing in Hong Kong allows, through the Stock Connect scheme with Shenzhen and Shanghai, allows mainland investors access to these companies, and I think that's as it should be. Actually, I mean, I think it's unhealthy that these companies are, they should be listed at home, but for various reasons, entry requirements in China, profitability requirements, track record requirements, and so on, basically made it impossible for many of these private tech firms and others to list in China. So it is quite a rigid system in China, but it's so to some extent, I think there's a bit of a rebalancing going on, which is not a bad thing. But I mean, hopefully these firms could remain listed abroad, because I think that's also positive for foreign investors. But yes, with this Holding Foreign Companies Accountable Act, it does seem the regulators in the US, I think, are going to be forced to make some tough choices in 3 or 4 years' time.
It's certainly, as you point out, sort of a singular kind of situation, in the sense of essentially profits or by these companies being kind of more, going to the benefit of foreign investors, and how that affects the Chinese economy more generally is a big question. One thing that you mentioned, of course, and I would like to zoom into it before we run out of time for this episode, is of course state ownership, which is prevalent, as we know, in the financial services sector for a variety of reasons. And I think Ant is also kind of perhaps sheds a further light as to how much the Chinese government wishes to control, retain control in the financial services sector. And we've also seen in a number of holding structures in the tech sector, now apparently the Chinese government has taken very small participations, like 1%, that allows it to nominate, and even with this 1%, somehow board representation. And that sort of seems to be, at least to me, watching it from the outside, slightly new developments. And I wonder if you could comment on that, but also more generally on these issues of state ownership, which, let's face it, are the elephant in the room in China, in a sense that, the interests of investors, foreign investors, and the Chinese government might diverge. And insofar as they're a shareholder in listed companies, the reconciliation of these interests is certainly something that would be of interest to investors, and especially investors. How do you see that unfolding in the coming sort of year, or 1 to 2 years, short to medium term?
Well, I think in terms of state ownership, there hasn't been as much state ownership corporate governance reform in recent years as we'd been expecting. Many years ago, they were playing up the idea of mixed ownership, which is basically bringing in, hiving off some state assets as a subsidiary, bringing in some domestic and foreign private interests, and reshaping the board of these companies and really trying to improve their governance. It was an exciting idea, but it was only ever going to be relevant to sort of subsidiaries that were spun off, like a subsidiary spun off from Sino-American back in sort of 2013, 14, its retail gas stations. That never developed as much as we thought it would. And since then, there have been reforms in state enterprises, but there's also at the same time been a reinforcement of the whole concept of the party committee. These are the committees of the CPC that basically sit at the top of these companies and have control over major decisions and major personnel appointments, and make sure that So on one hand, you've had some corporate governance reform, but you've also had a lot of reinforcement of what you can loosely call corporate governance with Chinese characteristics. And this idea of buying 1% of a company and getting a board seat, I think, is just a further reinforcement of corporate governance with Chinese characteristics and the state's desire to influence, and whether control is the right word, but certainly influence and supervise the behavior and performance of these major private enterprises is interesting. From a foreign investor perspective, you need to go in with your eyes open. China does have a different system of corporate governance. We wrote a report on this whole issue back in 2018. It's on our website in English and Chinese. And what we're trying to do really is explain, the uniqueness of the Chinese corporate governance system to foreign investors, and also to explain to Chinese companies, some emerging trends in corporate governance and ESG. And it is a very different system. The risks are different. There's always been regulatory risk, and I think you've seen that recently with the tech firms. You never quite know, what is going to happen because there isn't full transparency in terms of, policy developments. And clearly, China is a growth story and everybody wants to invest there. But, I think you have to, be well aware of how the system is different, not expect the system is ever going to become like your system. You can try and engage with companies, but the reality is it's very mixed. Some state enterprises are actually quite open. Others are very closed. It takes a long time to build relationships with them. So I think you just have to be aware that there is definitely some positive investments in China, but you really need to understand what you're doing, and you need to speak the local language, research in local language. So, but that's no different really from any market, right? So no. China is different, but it's predictably different, I would say. That's one thing good about the Chinese system, is that the CPC is quite a predictable organization in the way it sort of makes decisions. So whilst the policies that come out of the government may take people by surprise, there is a sort of degree of predictability in the way they view the markets.
Yeah, that is an interesting point, because I think it probably is not exactly how most institutional investors feel today. looking at, particularly as we talked about the dual listed companies. And so in the interest of time, I think, I would like to really thank you for your insights on China. Perhaps just one quick last question, because, we spoke at length on China, but I know you cover essentially all of, Asian markets. Would you say that the developments of China are singular, if you're an investor listening into this conversation, or, to what extent is there linkages to other markets, or are they completely decoupled, their own with each with their own sort of political and capital market dynamics? Like, are they, the type of, for example, board issues we discussed with state ownership and whatnot, somewhat echoed in other markets in the region, or are we really talking about China-specific dynamic that is different?
There are some areas, Alyssa, where China is following sort of what's happening elsewhere. For example, ESG sustainability reporting. There's been a lot of pressure on China to come out with some sort of guidelines on that, and there have been some sort of tentative moves in that direction. So there are some areas, certainly in terms of focusing on climate change, net zero, energy transition. So I mean, there are many themes, economic large themes that that resonate in China and around the world. But when it comes to corporate governance, when it comes to board governance, when it comes to state ownership, I think it is worth seeing China as different. And we don't see a lot of echoes in other markets to what's happening in China.
No, thank you very much, Jimmy, for insights. It's been a fascinating conversation. I hope that our audience have also found it so, and definitely encourage them to tap into the resources that you were mentioning on your website, and as I mentioned, a few articles that we've also put out on the particular dynamics between China and the US that we've explored in past dialogues, for example, with Carson Block on this program, and some of the issues that you're mentioning on climate disclosure is definitely a subject that we're looking at in future dialogues in this program. But for the purposes of today, I'd like to thank you and thank our audience for joining us for this fascinating conversation.
Thanks, Alyssa. It's been great. Thank you.